GTA housing market in May 2026 just threw us a curveball. And what it means for first-time homebuyers trying to find a detached home is not what most agents are telling you. The data shows surprising shift in certain communities. I'm Mihir and I specialize in helping first-time homebuyers navigating the complexity of GTA market, making sure they feel safe and confident at the offer table. Today, you will discover the real story behind May 2026 market trends, where your budget truly stands the best chance of securing a detached home and have to avoid overpaying in this competitive landscape. And by the way, if you are thinking about making a move to the GTA, I get calls and emails every single day from people just like you, and I absolutely love it. So whether you are moving in 9 days or 90 days, give me a call, shoot me a text, or send me an email. There's a link in the description to book a free, no pressure consultation. I would be happy to help you map a realistic path to getting your first home. Let's start with the full GTA picture. In May 2026, almost 6,500 homes sold. That's actually 6.3% year over year. So buyers activity is picking up, but here's the part that matters more. New listings fell by almost 19%. Sellers are pulling back. Less supply is coming to market while more buyers are showing up. That combination, rising sales, falling listings, is exactly what tightens a market. Prices are still 4.6% from last year. So buyers still have real purchasing power, but if you have been sitting on the fence, this data is telling you something. The biggest question I get is, should I wait for price to drop? I understand the hesitation, but waiting made sense in 2022 when rates were climbing and prices hadn't adjusted. Today, prices are down, rates are lower, and listings are shrinking. The second pinpoint is inventory. People are struggling to find homes in the 700,000 to 900 range. That range is being squeezed. Third, there are real economic anxiety. Toronto unemployment is at 8.1%. GDP contracted last quarter. Those are legitimate concerns. If you are looking at condo apartment, you need to understand that segment is the weakest right now, down over 9% year over year. That affects resale value. Now, let's zoom into the cities I work in every day. Mississauga had 568 sales in May with an average price of $971, just shy of $1 million. There are 5 months of inventory. That is a balanced to buyer market. Buyers there are getting homes at 97% in dollars. What does that mean? Is if you listed $1 million, they're gonna buy it 170,000. Burlington is tight, only 4.4 months of inventory, and prices are averaging around 1.2 million. Milton is the tightest of the group at just 4 months of inventory, which means it's moving towards seller territory faster than anywhere in the list. And Brampton, 5.3 months of inventory, almost 900,000 average market price. Brampton has most buyer leverage right now. Understanding where each city helps you make an offer with confidence rather than guessing. This is the slide I want you to pay the most attention to. There are official benchmark price changes, not averages, not estimates. Year over year changes tracked by track. Burlington is down just 3.5%. Townhouses in Burlington are down only 1.3%. They have held their value through this whole correction. That tells me Burlington is a strong hold. Milton is down about 5%. Mississauga down nearly 8%. If you bought a home there at a peak in 2022, you're sitting on 8% people loss. But if you are buying today, you are buying at that discount. Now, look at the right side. Aurora is down down 12%. Richmond Hill is down over 12%. Markham townhouses down 16%. This is where people are catching falling knives. Staying in 600,000 to 900 range in Mississauga, Burlington, and Milton keeps you away from those volatile segments. The SNLR, sales to new listing ratio, tells you how competitive market is. Ajax is Durham at 45% with only 2.9 months of inventory. Homes are moving fast and buyers are paying full asking. Toronto is even more competitive. 103% SP to LP means people are paying over asking. Milton is sitting right at the edge. Burlington is close behind. What this means practically, if you're buying in Milton or Burlington, you can't take 2 weeks to think about it. If you are buying in Mississauga or Brampton, you still have negotiation room, but it's compressing. Now, here is the flip side, where buyers have the most room to negotiate. Brampton at 5.3 months of inventories, clear buyer's market. You can ask for a price reduction, an extended closing, a home inspection, things that were off the table 2 years ago. Mississauga is similar. On the other hand, King Township has 11 months of inventory, but that's luxury price points. The takeaway, Brampton and Mississauga give you the most room to negotiate. Milton and Burlington are tightening. Your strategy depends on which city you are targeting. Let me bring this down to the homes types you are actually looking at. Townhouse in Burlington are down only 1.3% year over year. That's your best equity story right now. Milton townhouses at 825,000 and Burlington townhouse at 925,000 are right in the range we were. Detached in Mississauga at 930,000 is still accessible. Now, condo apartments. I have to be straight with you about this. Brampton condos are down nearly 13% in 1 year. Mississauga condos are down almost 10%. If you buy a condo apartment right now, you need to understand there is more downward pressure in that segment and it takes longer to sell. That's not to say you can never buy one, but go in with the clear eyes. For a first-time home buyer and young families, the 700,000 to 900,000 townhouse range in Milton, Burlington, Mississauga is most balanced spot in this entire market. Here's where I want to be really clear because this is the part that most people miss. Month over month, May sales were up 10% from April. Listings fell another 2%. That's a tightening trend. TRAP's own chief information officer said in this very report, and I'm quoting directly here, if sales straighten further relative to listings, prices will level off and start to grow as we move into 2027. The Bank of Canada is at 2.3% overnight rate, some of the lowest borrowing costs we have seen years. Now, housing legislations, Bill 98, just passed to make building easier, but new supply takes 3 to 5 years to hit the market. What does that mean for you? The discount window you are looking at right now, 4 to 8% off peak Burlington and Milton, is likely the best entry point before the next upswing. I'm not saying prices will explode. I'm saying the conditions for recovery are being set right now. And by the time it's obvious to everyone, the opportunity will be gone. I'll give you a 30-second history lesson so you have context. The GTA market peaked in 2022. Average price hit almost 1.2 million. Since then, it's come down. Today, we are at 1.07 million on average, just shy of 1.1. That's about 10% correction from peak. This is not a crash. In 2016, the average price was 731,000. We are still well above that. In 2019, before the pandemic run up, prices were 812,000. The market went up 47% in 2 years and has come back down about 10%. This is normal corrections after an extraordinary run. And now, with the sales picking back up and listing declining, the floor looks like it's forming. Here's why I do what I do differently and why it matters in this market especially. I'm both a certified appraiser and a licensed real estate agent. That's a combination very few people in this market have. When I look at a home for a buyer, I'm not just running comps and picking numbers. I'm applying formal appraisal methodology, the same process used by lenders to value collateral. I look at street level data, not just a community average. In Churchill Meadows, for example, one street can price 50,000 differently from the next because of school catchment, backing onto park or a traffic. That's the level of details that protects you from overpaying or from being too conservative and losing a home you actually want. If you have made to this slide, you are probably in the planning phase, and that's exactly the right time to have a conversation, not when you are already stressed about an offer deadline. I do free strategy call when we talk about your specific situation, your budget, your timeline, which city makes the most sense for you, and what to expect in terms of inventory and competition. I'll tell you honestly whether now is the right time for you or whether waiting another 60 days makes more sense. There is no pitch, no pressure. The link is on screen. Book a time directly or message me on WhatsApp at 647-787-6325. I'm usually pretty quick to respond. Thanks for watching.